On April 24th, 2019, AT&T reported first quarter financial results for the period ending March 31st. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about AT&T's business model. AT&T is a leading provider of communications and digital entertainment services in the United States and worldwide. The company provides internet access, as well as television and wireless services to millions of consumers. AT&T trades on the New York Stock Exchange with a market capitalization above $237 billion. AT&T is one of the world's most popular high-yield dividend growth stocks. The company's current dividend yield is north of 6%. Moreover, AT&T is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 35 consecutive years. This qualifies AT&T to be a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning AT&T stock will be interested in the safety of the company's current dividend payment. For the remainder of this video, we will discuss AT&T's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss AT&T's dividend safety in the context of the company's current earnings. In the first quarter of fiscal 2019, AT&T generated adjusted earnings per share of 86 cents, which compared favorably to the 85 cents of adjusted earnings per share in the same period a year ago. For context, AT&T currently pays a quarterly dividend of 51 cents per share, which implies a payout ratio of 59% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. AT&T generated $3.52 of adjusted earnings per share in fiscal 2018. The company distributed $2 of common share dividends during the same time period for a dividend payout ratio of 57% in the full fiscal year. Using earnings, AT&T's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare AT&T's current dividend payment to its free cash flow. AT&T generated $11.1 billion of cash flow from operating activities in the first quarter of fiscal 2019 and spent $5.2 billion on capital expenditures during the same time period for free cash flow of $5.9 billion. The company distributed $3.7 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 63%. Looking out over a longer time horizon, our conclusion is the same. AT&T generated $43.6 billion of cash flow from operating activities in fiscal 2018 and spent $20.8 billion on capital expenditures for free cash flow of $22.8 billion. The company distributed $13.4 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 64%. Using free cash flow, our conclusion for AT&T's dividend safety is the same as when we use earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze AT&T's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. AT&T's performance during this time period is shown here. AT&T's earnings per share declined by 22% peak to trough in the worst of the 2007 to 2009 financial crisis. With that said, the company's earnings still covered its dividend payment, and it continued its multi-decade streak of dividend increases. Because of this, we have little concern about its ability to pay rising dividends during future economic downturns. The last angle that we will use to assess AT&T's current dividend safety is by looking at the company's debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest rate will have to increase before its free cash flow would no longer cover its dividend payment. At the end of the first quarter of fiscal 2019, AT&T had $193.4 billion of total debt outstanding. The company generated $2.1 billion in interest expense in the most recent quarter for a weighted average interest rate of 4.3%. The following image shows how changes to AT&T's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, AT&T's weighted average interest rate would need to rise to above the 8.7% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on AT&T's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on AT&T's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.